Hi, everybody. I just wanted to give you a quick overview of depreciation. I've covered this in a previous video, and I hope you'll take a minute to watch it. You have to look at what you're buying and whether to decide to expense it, which is write it off immediately, or capitalize it, make it an asset, and then write it off over the period of time that it's benefiting you. Uh, so there's some criteria that you go through. Let's say that you have decided that this is a long life asset and it is an asset that's going to benefit you more than one period and that we are going to depreciate it. Well, we know that whatever method we choose, this is what the journal entry is going to look like. That it'll be a debit to depreciation expense and a credit to accumulated depreciation. So that's our journal entry every year. What the difference is going to be is how much money, how much of it that we are depreciating each period. And so our methods include straight line depreciation. It's the simplest and used quite often. It gives us the same amount of depreciation every period. It's simple to compute and to check back behind others. We've got some accelerated depreciation methods, units of production, uh, declining balance method, which is really double declining balance method, and that's double the straight line rate. And then there's a accelerated depreciation method called sum of the year's digits. It's hardly ever used now, but I'm going to do a short video on each one of those four depreciation methods so that you'll understand the mechanics behind it. Then I did want to mention, the for income tax purposes, the first four are for financial statement purposes, and we do have some income tax methods of depreciation. The first one, the modified uh, accumulated cost recovery system, I've heard it MACRS and MAKERS. It's based on the double declining balance method. Uh, you can use straight line for the income taxes depreciation. You can use a declining balance method called 150% declining balance that doesn't accelerate it quite as much as the double declining balance method. And they also have the Section 179 expense, and that you can use to just immediately expense uh, uh, the cost of an item up to a certain amount. So all those will be covered in a tax course that I'm not going to cover. Uh, if you uh, get into a situation where you are a small business owner or you just want to know more about taxes and you're interested in income tax depreciation, I do recommend a book. Uh, it's called Your Income Tax. It's J.K. Lasser, Your Income Tax, published by Wiley Publishing, Wiley, and it's J.K. Lasser, Lasser. It's an excellent book, updated every year for the tax law. My goodness, that thing's several hundred pages long. It's a big one. Paperback. You can get it at Amazon or Barnes and Noble anywhere. It's between $25 and $30, but uh, I've used it before. And if you are, like I say, if you're definitely in business, or you maybe want to get into some rental property, or you just want to know more about income tax, so that you can know enough to at least talk to your accountant about uh, what can I do to lower my taxes. It's a good starting point. It's a good book for insomnia too. If you can't sleep, there's nothing like good reading taxes to put you to sleep. But it's a yellow and red softback edition. Like I said, I don't get anything for plugging it, but I've used it for years and recommend it highly. J.K. Lasser, Your Income Tax, and it'll tell you more about income tax then you want to know when they've got a chapter or two or three on this depreciation. So if you want to study some more, that's a good place to start. But anyway, we're going to concentrate on those first four methods. And like I said, whatever method we use, we're going to expense it and debit depreciation expense and credit accumulated depreciation every period. So we're going to be looking at straight line, units of production, double declining balance, and sum of the years digits method. Remember that uh, depreciation is writing off uh, an asset's cost over its estimated useful life. If you don't have a clue about what the estimated useful life might be, go to the IRS publication on depreciation, and they have a estimated useful life for tax purposes for anything you can imagine, from from a car, truck to livestock, cell towers, anything you can imagine. The IRS has run across it and has got it in uh, the IRS publication on depreciation. But anyway, we're writing off an asset over its estimated useful life. And don't forget, if it's a tangible or fixed asset, we call it, you're still writing it off. But if it's a tangible or fixed asset, you call it depreciation. If we're writing off an intangible asset like goodwill or patent or a trademark, that's considered amortization. Most of the time, when it's not a fixed asset, if it's a tangible asset, we're going to like goodwill, we write it off a straight line over its estimated useful life. Uh, Under depletion, it is a natural resource asset: coal, oil, gas, diamond mines. I mean, whatever you might be buying in a natural resource asset. And the depletion method normally is like the units of production. You get a geologist to tell you how much it's worth, and then as you take it out, as you extract it, you allocate the costs out as you extract it. And we remember that land itself is not depreciable. You know, the old real estate adage is beneath all is the land, and it's still here, still going to be here. And so land is not depreciable. And don't forget, in the general rule in capitalizing an asset, that all the costs necessary to get that asset into productive use are added or capitalized to the cost of that asset to get its cost, or as we accountants say, its basis. Anyway, uh, hope this helps, and we shall see you next time.